When you open an app on your phone, type in a friend's details, and hit send, what exactly is crossing the ocean? Every single pulse of light is a digital instruction to shift a number from one column to another. The currency itself never physically moves, only the claim to it changes hands through a complex labyrinth of digital ledgers. We interact with this plumbing every single day without a second thought. Millions of transactions flow seamlessly across borders, entirely invisible to the public. Usually, the only time anyone notices this system exists is when someone purposefully turns it off. Beneath the illusion of instantaneous, borderless money lies a highly centralized infrastructure. It functions through a network built on trust, standardized protocols, and a handful of critical choke points. In late February of 2022, that hidden infrastructure was weaponized. Major Russian financial institutions woke up to find their connection to the global plumbing completely severed. The economic fallout was immediate. Cross-border trade flows stalled. Hundreds of billions of dollars in annual transactions were frozen in place, and the value of the ruble plunged nearly 30% in a matter of weeks. Which raises a mechanical question. If money is just data on servers, how do you actually execute a strike like that? How is it mechanically possible to mathematically erase an entire nation from the global economy? To see how this lever of statecraft functions, we have to look past the sanctions and the press conferences. We have to forensically investigate the hidden mechanics of a single international wire transfer. The first name that comes up in any discussion of international finance is SWIFT. It's assumed to be a massive vault or a clearinghouse physically moving cash around the globe. It does none of those things. Back in the 1960s, global banks relied on slow, error-prone telex machines to send payment instructions. A single cross-border transaction could require 10 different typed messages, and a single typo meant the payment failed entirely. SWIFT was created in 1973 simply to standardize that communication layer. Look at this standard transfer diagram. SWIFT uses the MT-103 message, a secure text telling Bank A in New York to debit an account, and Bank B in the UAE to credit one. Without direct relationships, messages route through intermediary correspondent banks to bridge the gap. SWIFT is the postal service of global finance. It delivers blueprints dictating how money should move, but it never touches the value itself. If SWIFT is only passing notes between banks, where does the actual money change hands? To answer that, we have to split the process into two distinct phases. Clearing is the routing of the instructions and the tallying up of promises between institutions. Settlement is the actual final discharge of that financial obligation. In a real-time gross settlement system like Fedwire, transactions aren't batched. They settle individually, instantly. The central bank simply debits one commercial bank's master account and credits the other using central bank money. Once that ledger updates, the payment is final. The entire illusion of a global digital payment system ultimately bottoms out here. It relies on a handful of central banks shifting liabilities back and forth on their master ledgers. But is the money being moved on those ledgers actually sitting in a vault somewhere? The short answer is no. Modern finance operates on the principle of fractional reserve banking. This spreadsheet reveals how money is created. Deposit $100. The bank keeps a fraction in reserve and lends the rest. That loan becomes a new deposit, lent out again. A single deposit cascades down, multiplying into new broad money out of thin air. Regulators enforce a liquidity coverage ratio to keep this from collapsing. Banks are only required to hold enough high-quality liquid assets, like central bank reserves or government bonds, to survive a hypothetical 30-day run by depositors. The millions of dollars flowing through the wires right now are not backed by physical cash. They are a highly leveraged web of promises. The entire structure remains upright only because every institution implicitly trusts that the others can honor their debts. Because the system requires specific routing hubs and clearing networks to process those promises, it creates massive, centralized choke points. This brings us back to the sanctions levied against Iran, and more recently, Russia. When Western powers block a nation's banks from the SWIFT messaging network and cut ties with their correspondent banks, the settlement chain completely breaks. The instructions stop, and the ledgers cannot update. Without access to these central ledgers, a targeted nation is paralyzed. They cannot easily receive payment for their oil and gas exports, nor can they pay external suppliers for critical imports. The supposedly neutral plumbing of international finance functions as a coercive system. It allows the nations that control the master ledgers to inflict economic devastation without firing a single shot. The global reaction to this tactic has been swift. By demonstrating that access to the world's money is conditional, the architects of the system have terrified non-Western nations about their reliance on US and European-controlled networks. As a direct result, we are seeing the rapid acceleration of sovereign alternative payment systems. China's cross-border interbank payment system, known as CIPS, and Russia's SPFS are designed to process domestic and allied transactions entirely outside the reach of Western choke points. These parallel networks are gaining traction. Operating across multiple rails increases costs and friction, but it promises autonomy, threatening to permanently fracture the global economy into competing, incompatible financial blocks. Global hegemony is increasingly tied to these digital rails. While military power remains a constant, the ability to control and fragment the world's money is a new, decisive front in global competition.